A key factor to consider while monitoring systemic risk is to understand very well what the sources of the problems are. Systemic risk is driven by bad shocks in the economy. An example of a bad shock is when asset prices are driven by irrational forces away from fundamentals. And banks decide to ride on those asset price booms by lending out more and more to unworthy customers. An example of a good shock is when technological innovations improve incomes permanently. It is important to distinguish between these two shocks because policymakers don't want to be squashing healthy developments in the economy. Among financial indicators that signal a buildup in systemic risk, credit growth is central. But credit growth needs to be accompanied by other indicators for policymakers to distinguish good from bad shocks. Among other indicators, asset prices form powerful signals together with credit growth. Our analysis shows, for instance, that when credit to GDP ratio is growing by more than 5 percentage points, accompanied by equity prices growing by more than 15%, there is 1 in 5 chance that financial crisis is going to hit in the next 2 years. Systemic risk can be mitigated by appropriate policy tools. Countercyclical capital requirements is being currently discussed among several policymakers. This is the requirement that banks hold more capital when systemic risk is going up, and they draw down on these capital when systemic risk is about to materialize. Our analysis shows that such requirements can be used effectively in different types of countries across different exchange rate regimes. However, in its design, it needs to take into account country-specific circumstances. This is especially so in managed exchange rate regimes with widespread foreign currency lending.